There is this house I want to buy, but I don't have 20% down. I can't get a gift from my relatives. I don't want to borrow against my retirement account. And I believe that this home is a really good opportunity. Does anyone believe in me?
This is a common barrier to buying a home. And if you're wondering how to go about it, then this video is for you. A healthy mortgage market is a key ingredient to a functioning housing market. As home prices continue their trajectory, one way or another, expect changes to loan programs and enhancements to keep the music playing. One of the major developments responsible for the expansion in home lending was the creation of mortgage insurance. When you're not able or willing to make 20% down payment on a home, how do you keep the dream alive? Well, from a little helper they call MI. That's mortgage insurance. It's not a new concept. It's more than 67 years in the making, and it never seems to go out of style. In fact, there are several programs out there to help accommodate this type of scenario, officially known as PMI, or private mortgage insurance. PMI allows prospective buyers to make less down payment, increase the leverage when buying a home using traditional loan types. It's used extensively to allow borrowers to obtain loans in which the loan-to-value LTV ratio exceeds 80%. It can be done in any increment, say 82 or 83%, but it's usually done in a factor of 5. The benefit to the home buyer is less capital investment, but understand PMI protects the lender in the event that the borrowers default on their mortgage payments when the house is not worth enough to entirely repay the lender through a foreclosure sale. In a nutshell, that's how this concept works. But like your imaginary friend, one day you may grow out of MI. For the limited long-term benefit, lack of protection, most borrowers want to shake PMI as soon as possible. But did you know there are actually two types of PMI? Borrower-paid mortgage insurance, BPMI, and lender-paid mortgage insurance, LPMI. In the next 20 minutes or so, I'll explain the two, ID which one you can cancel, the paths of cancellation, and a history and impact on the business since its inception in 1957. First, understand that the use of PMI is one of the many ways to structure a mortgage. It's not the only way to do so. The mortgage business changes on a dime, and there are times when other vehicles like piggyback second mortgages become a better fit and a way to avoid PMI altogether. Like everything in finance, there are pros and cons, and the major drawback to PMI is that it benefits the lender in case of default. Do not confuse PMI with mortgage, life, or disability insurance, which one can purchase separately and not associated with a loan. That style of insurance, called mortgage protection insurance, also called MPI, credit insurance, and debt cancellation or suspension coverage, is a safeguard to make mortgage payments in the case of a borrower's disability or pay off the mortgage in the case of death. Many people confuse the two and think they can opt out of mortgage insurance. Unlike MPI, which is optional, consumers can't opt out of PMI if they take a single loan with less than 20% down payment. PMI works like a tax on top of the payment, sometimes seen and unseen as a risk premium for less skin in the game. It's not always a forever tax. It is possible to eliminate PMI mortgage insurance premiums depending on the loan type. I mentioned earlier the use of credit lines, home equity lines, but the scenarios we are going to deal with today focus on the single loan purchase money mortgage. 25 years ago, legislation was passed with the Homeowners Protection Act for those that bought homes after July 29 of 1999. Before that time, lenders could require PMI, but cancellation of that insurance was totally at the discretion of the lender. Even if a consumer paid down the loan, there was no firm requirement for the lender to cancel the insurance. In addition, many lenders could have arranged for the mortgage insurance cost. Funny thing was, it did a great job helping homeowners acquire property, but after those same loans aged, neither party really benefited as the loan balances amortized, reducing the lender risk of foreclosure, while the payment premium did nothing to help the borrower one iota. Before the change, lenders accepted the postulate to terminate PMI once they got to 20% or more equity. but it lacked proper management. There was not yet conformity for the policies to cancel or terminate years after the loan closing. Lenders may have agreed to terminate the coverage when the borrower's equity reached 20%, but didn't have any way to gauge it. Additionally, homeowners had limited recourse when lenders refused to cancel their PMI coverage, as some states had different rules pertaining to PMI cancellation. So, the HBA created and established these principles we see in the business today. The HPA applies mostly to residential mortgage loans, defined as mortgage loan transactions consummated on or after 7/29 of 1999, to buy, borrow, and build a primary residence for the purposes of occupying. The Act also includes provisions for annual written disclosures for residential mortgages, defined as mortgages, loans, or other evidence of a security interest created from a single-family dwelling that is the borrower's principal residence. Moreover, the Act changed PMI for the future by requiring lenders to cancel PMI when the loan reached 80% LTV as requested by the borrower, or when the loan balance reaches 78% LTV, which is mandatory cancellation. If those two don't work for you, don't worry, there's a third gear. Should you take PMI and pay down the note to 80% of the home's original value and meet other certain criteria, give your lender a ringy-dingy and request cancellation of the mortgage insurance. If you're a fan of paying extra monthly with biweekly payments, there's always the possibility that the accelerated amortization will get you below 80% quicker. 80% of what, Maddie? The price I paid or the market value today? Actually, it's based on the original amortization when the loan closed. It's different from simply having 20% equity in the home based on current market value. We've seen huge home appreciations since the pandemic, and it may be a tough call how to back into that less than 80% figure. Borrowers can request cancellation earlier than the date that the loan was originally scheduled to reach 80% of the original value, but the lender isn't required to approve the request. If you just purchased the home, you may feel that you're already below the watermark, but you're going to need to articulate the increase in value to the lender. Did you complete home improvements you can document? If it's simply another home on the streets listed for 20% more than you bought it last month, or you bought it undervalued, those claims may not be enough. Lenders are required to outline your PMI up front. It's not applicable to commercial mortgages, and there are differences with mortgage insurance on a fixed rate opposed to an adjustable rate mortgage. Exact procedures for canceling PMI are prescribed by law. Those procedures vary based on whether the cancellation is borrower requested, automatic, or final. Lenders love documentation, especially when a borrower requests to cancel. Therefore, the requested cancellation process begins with a written request to the lender. The servicer, if not the same as the investor, must take action to cancel PMI when the cancellation date occurs, which is when the principal balance of the loan reaches, again, based on the actual payments, or first scheduled to reach 80% of the original value, irrespective of the outstanding balance, based on the initial amortization schedule. In the case of a fixed rate loan, or amortization schedule then in effect in the case of an adjustable rate loan, or any date thereafter. Let's bring this scenario to life. Let's say, for example, you buy a starter home that needs some TLC, and since you're handy with the steel and had just enough money saved up to qualify for a 5% down loan, you make the deal work using a loan with PMI. After a lot of elbow grease and adding some square footage, perhaps some new flooring, and some kitchen cabinets, you feel the loans reach 80% loan to value. Now you've only been in there for 36 months. Can you request the removal of MI? The Act says yes, the consumer may request to have his or her PMI canceled if all of the following criteria are met. First, pay down the mortgage. Second, timely payments. Third, improved value. Fourth, written request. Feeling 4 for 4? Then you can contact your lender and ask for the physical challenge. After your case is reviewed, the lender will cancel the PMI and not require further MI based on one of the following: 30 days since the request was received, or date in which the borrower satisfied the evidence and certification requirements of the mortgage holder as outlined. Sounds easy. What's the catch? It's that the borrower may have to pay for an appraisal to justify the value of the property meets the cancellation requirements. I think a small price to get MI off your back. There's no provision in the automatic termination section of the Act, as there is with borrower-requested PMI cancellation section, which protects the lender against declines in property value or subordinate liens. The automatic termination provisions do not depend on good payment history, as required under the borrower-requested cancellation, but state only that the borrower must be current on his or her mortgage payments. Once a consumer's paid down the mortgage to 78% of the original value, the law states that the lender must automatically cancel PMI on that loan. The Act requires a servicer to automatically terminate PMI for residential mortgage transactions on the date that one of the following situations occur. The principal balance of the mortgage is first scheduled to reach 78% of the original value of the secured property based solely on the initial amortization schedule in the case of a fixed rate loan, or the amortization schedule in effect in the case of an adjustable rate loan, an ARM, irrespective of the principal balance, if the borrower is current. If the borrower isn't current on that date, on the first day of the first month following the date that the borrower becomes current. So, payment history is also ever important. Let's workshop this idea. Let's say you purchase a home for $100,000 on January 1st of 2024 and put down 5% and take a $95,000 mortgage with mortgage insurance. It's a 30-year fix. Let's assume the rate's 7% and your monthly P&I payment is $632 monthly. When is the projected date your PMI will automatically go bye-bye? Let's follow the amortization schedule and see by month, November in the year 2035, your loan balance will reach $77,859. By that time, you'll be a few dollars below the 78% threshold and your mortgage insurance will mature. Like it or love it. Remember that third gear I referenced? There is one other important requirement. A lender must terminate PMI if the borrower reaches the midpoint of the loan's amortization schedule before the 78% date. The midpoint of the loan's amortization schedule is halfway through the life of the loan. Most loans are 30-year loans, so the midpoint would occur after 15 years have passed. Termination of PMI at the loan's midpoint may occur before reaching 78% of the original value of the home for people that have a mortgage with an interest-only period, a principal forbearance, or possibly a balloon payment. Keep in mind that the customer must be current on the monthly payments for the termination to occur. Oh, and let me not forget, the scenarios above apply to conventional loans. If the loan is guaranteed by the FHA, these rules generally will not apply. If PMI coverage on a borrower's home was not canceled at the borrower's request, the servicer must terminate PMI coverage by the first day of the month immediately following the date that is the midpoint of the loan's amortization period. If, and on that date, the borrower is current on the mortgage payments required by the terms of the mortgage. If the borrower is not current on that date, PMI should be terminated when the borrower does become current. The midpoint of the amortization period is halfway through the period between the first day the amortization period establishes at consummation and ending when the mortgage is scheduled to be paid in full. The servicer may not require further payments or premiums of PMI more than 30 days after PMI is terminated. Let's bring this scenario to life. Imagine way back in 2009, you got a mortgage that is now 15 years into the 30-year term. When you bought it, you put down only 10%. You planned on refinancing it one day, then the pandemic happened, you lost your job, and you missed out on the opportunity to refinance. With a loss of income, you got behind on the payments a few times a year but recently just landed your new dream job. Let's assume for argument's sake that the loan is not at 78% for the mandatory cancellation, but by making up the deficit, you are current again and eligible for final termination PMI. Some other caveats showing MI the door include loan modifications. If a borrower or mortgage holder agree to modify the terms and conditions of a loan pursuant to a residential mortgage transaction, the cancellation, termination, or the final termination dates shall be recalculated to incorporate the modification. Also, exceptions to cancellation and termination include provisions for high-risk residential mortgage transactions. The borrower requested cancellation at 80% LTV and the automatic terminations at 78% loan-to-value requirements of the Act do not apply to high-risk loans. However, high-risk loans are subject to final termination and are divided into two categories: conforming, those Fannie Mae, Freddie Mac defined high-risk loans, and the non-conforming, which are lender-defined high-risk loans. Conforming loans are those loans with an original principal balance not exceeding Freddie Mac or Fannie Mae's conforming loan limits, currently at $766,550. The Act says these kinds are not subject to borrower-requested cancellation or automatic termination because of the high-risk feature associated with them. But both Fannie and Freddie are subject to the final termination provisions of the Act. If the borrower isn't current on that date, PMI should be terminated when the borrower does become current. Non-conforming loans, those that exceed the conforming loan limit by the state and county, as lender-defined high-risk loans, are not subject to the Act's requirement for the borrower-requested cancellation or automatic termination. However, if a residential mortgage transaction is lender-defined high-risk loan, PMI must be terminated when the balance first scheduled to reach 77% of the original value of the property securing the loan. Now, I just want to touch on MIP and the FHA. Understand that FHA loans work differently than conventional, and generally MI and FHA are soulmates. FHA loans require upfront MI at closing and monthly MI paid with a payment. Although the MIP is calculated on an annual basis because it's remitted monthly to FHA, it's sometimes referred to as monthly insurance premium. In some circumstances, MIP is collected for the life of the loan. In other circumstances, MIP has a limited duration. For all mortgages, regardless of their amortization terms, any mortgage involving an original principal obligation, which is excluding the financed upfront MIP, less than or equal to 90% LTV, the annual MIP will be assessed until the end of the mortgage term or the first 11 years of the mortgage term, whichever is first. For any mortgage involving an original principal obligation, excluding the financed upfront MIP, with an LTV greater than 90%, FHA will assess the annual MIP until the end of the mortgage term or for the first 30 years of the term, whichever is first. Great, Maddie, but I just took an FHA loan last year when the rates were higher and I plan on refinancing soon. So what happens with that upfront MIP? Good question. The underwriter must obtain a refinance authorization from FHA in connection to determine the refund. When there is a refund, the refunded amount is deducted from the new loan amount's upfront MIP, and any remaining MIP balance is due or collected at closing or could be financed into the loan amount. If the refunded amount is greater than the new MIP amount, a check will be mailed to the borrower for the overage. There's got to be an easier way. I've always said this business is about options. PMI with the borrower paying for it is only one way to do it. It's not the only way to do it. So go back to your lender and tell them you don't believe in PMI. It's against your religion. If you want it lender, then you pay it, because I refuse to live with MI. And likely they may say, okay, because some lenders provide borrowers with another option. LPMI, or as described earlier, lender-paid mortgage insurance. With LPMI, the mortgage insurance is either built into the closing cost or paid through a premium rate. Before you get all aggro, understand LPMI is often less expensive than monthly PMI payments. So is there a catch? Yeah, LPMI policies can't be canceled. To kill it, they need to be either refinanced or paid in full. It is lower cost, it is refinanceable, but is it the lesser evil? It may or it may not be, and it may come down to the cost involved to refinance the loan. And will the cost be recovered in 12 months or 36 months or somewhere in between? The answer may be a factor of how long are you going to keep the loan or the property. Then again, that's just like any other refinance. If the lender requires LPMI for a residential mortgage transaction, the Act requires that the lender provide a written notice to the borrower not later than the date on which the loan commitment is issued. The written notice must advise the borrower the differences between LPMI and BPMI by notifying the borrower about the following LPMI conditions. First, it differs from BPMI because it cannot be canceled by the borrower or automatically terminated as provided under the HPA. Next, it usually results in a mortgage having a higher interest rate than it would be in the case of BPMI. Last, it terminates only when the mortgage is refinanced, and that term is defined in the Truth in Lending Act and Regulation Z, or it's paid off or some otherwise terminated. The notice must also provide the following info: that the LPMI and BPMI both have benefits and disadvantages. A generic analysis of the cost and benefits for a mortgage in the case of LPMI versus BPMI over a 10-year period, assuming the prevailing interest and property appreciation rates. That the LPMI may be tax deductible for federal income taxes if the borrower itemizes expenses for that purpose. BPMI means that PMI is required for a residential mortgage transaction, the payments for which are made by the borrower, while LPMI means PMI that is required for a residential mortgage transaction, the payments for which are made by a person other than the borrower. Generally, BPMI is financed through premium amounts added to the borrower's monthly mortgage payment, while LPMI is financed through a higher rate on the loan. Most lenders recognize there's little point in requiring PMI after it's clear that the borrower is making his or her mortgage payments on time, and that the borrower has enough equity in the property to cover the loan if the lender has to foreclose. If a lender refuses to cancel PMI in accordance with the law and in a timely manner, a borrower may take court action. Servicers, lenders, and mortgage insurers are liable to borrowers when they violate the Act. Just note that there's a statute of limitations. A borrower must bring action under the Act within 2 years after the borrower discovers the violation. So, there you have it. The mortgages business little helper. Are you a believer in it? Well, at least now you know better. You know how to use it and how to lose it, and a little bit about the history and what to expect. Hopefully you believe in me, unlike that pesky PMI you'll soon outgrow. And I'll see you back sometime soon. Because Maddie, I always got your back.